you're not supposed to be allowing anybody else to make those expert decisions, right? Like who to hire, how much to pay, and so on and so forth. So they're the money partner. They don't control the money. They bring the money. You control the money. Okay.
Right.
So that's the first way. The way that I find is better to outline uh, um, shares and responsibilities is that nothing is done on promises. Okay. So if she wants to pay, like if people are to pay paid on credit card, that's like a weird way to say that you want to do stuff. The money needs to be available to start. So if we know that this JV requires $200,000, we're going to make sure that there is $200,000 in the account.
Right.
Okay, like that has to go in there. It can't come in later on a promise or anything like that. Like it's very you can find yourself getting into sticky positions if you do it that way. Now, where the money partner technically also falls into a risky territory with you as an active partner, because what if you do not fulfill your end of the promise? Usually the problem is actually the other way around. Right now you're having problems with your money partner, but oftentimes money partners find they have problems with the active partner because they do a poor job of whatever it is that they promised they were going to do, and that
Right.
ends up being problematic, right? So in where you're supposed to make the decisions and keep the money partner more or less silent,
Hmm.
you need to be making those decisions, and they need to be making sure that you are fulfilling your active role so that the property has whatever the goal is of the property that needs to be fulfilled. And the problem with guaranteeing that you're going to get 50% for your efforts is that what happens if your efforts don't pan out, or you just didn't do what you're supposed to. So efforts don't pan out, meaning what happens if you do all this work and you break even? You essentially don't make any money. You did a ton of work, right?
Right.
And then let's just say that you failed to do something. Your money partner no longer has an option to even pay somebody else to do what you are failing to do,
Right.
right? So this is where in a JV agreement, the best way to outline it is actually to do whoever's putting in the money gets, let's say the way we do this anyway, is 70% goes to the money partner, 30% goes to the active partner, but all the work that you do, which in this case you said they were doing with a contractor, so you'd be doing project management,
Right.
that all needs to be paid as you complete it. And the benefit to this is that when you put that money into the pot, if anybody fails to fulfill responsibilities, you have money in the pot to pay somebody else, because when you're locked into promises, it makes it difficult to exit when somebody hasn't fulfilled, because you have no money to compensate. So you have to make sure that you have some way to pivot as a form of punishment for lack of fulfillment of responsibility.
Right.
Okay, so that would be the best way to do it. Now, in this case, you said that you've incurred some losses, and losses of money and losses of time due to this issue with the contractor, right?
Yeah. So the crazy thing is, so this contractor insisted on putting it on PayPal, and she was only able to put 13,000 on it. Total. Well, it was 34,000 that she gave him as a deposit. Because I filed a police report for fraud, she was able to retrieve $13,000 of it. But when it came time for the renovations, she decided to put it back on her credit card and didn't give it to me. So I've been dishing all the money up until now.
Okay, so how much was the property that you bought?
My property that I bought at the time, we bought it for 410.
410,000. Okay. What did the money partner use do for down payment?
For 20%, minus 5,000.
20%.
I put $5,000 down.
Okay. 20%. And they came up with capital reserve for carrying costs and for maintenance, right? Or for
Yeah,
renovations.
right.
Is
And
this a flip?
well, no, we're gonna hold it. We're gonna refi it. We're gonna burr it.
Okay. So if that's part of the battle plan, then how long were you anticipating the burr to take?
Well, we're anticipating to pull up money within a year, but now it's gone on 2 years.
Okay, so within 1 year, let's just call it up to a year, that you anticipated to do that. And let me just see here. Were you with a lender or private?
No, a lender.
A lender. Okay. So that's good. Did you go in? I'm assuming you're going on over a year now. So when you went in, what interest rate did you lock in at? You went
Uh,
variable, right?
no, I think she went locked actually, because she's holding the mortgage. Um, her mortgage I know right now is 2,100.
Got it. Okay, so that means that she's probably in a relatively it sounds like she's in a lower lock. So
Yeah, it's a pretty good rate. I know they locked her in.
okay, so basically it sounds like you needed something in and around $80,000 for the down payment. And then how much did you budget for the renovations to burr the property?
About 120,000.
Okay, so you're in this whole thing for about two. Okay, so the number I was giving as an example, so you're in about $200,000 worth of capital plus carrying costs.
Yeah.
Okay, and you have some rent. Do you have any units rented?
Yeah, we have the upstairs rented for 2,100.
Okay, and how many units are vacant?
One more.
One, so it's a duplex. Okay, got it. All right. Okay, 2100 here. Okay, so here's how it should work. So usually, if somebody else in a traditional JV agreement or in a partnership, what you would have is if you have somebody defaulting in financial responsibility, which in this case it sounds like there is a default in financial responsibility, you are now clawing in to that default. So what would effectively happen is if the agreement was clear, it would have a section like our agreement has a section in the terms where when one partner falters, let's say financially, and the other partners have to get involved, that amount of money either gets charged in at an interest rate where you can treat it like a loan, or that ends up buying into the equity share. Because if that money didn't come to begin with, so let's say if you required 200,000 to begin with and she only put in 160 for 50% of the share of the profits, that means that if you now put money in, you should be taking the proportionate $40,000 worth of her share, which that's, let's call it 50 for easy numbers. If she put 150 and she's lacking 50, that means that the other $50,000, which is 25% of her share, is what you should get. So she's getting 50%, you do 50%, you're going to take 25% of that. And that is ultimately how that should work. So if you this would be a sort of clawback into the financial distribution, and you do this. You're only really effectively be able to do this if this is clearly outlined. But in the event where it's not outlined, it becomes very ambiguous, and this is why you kind of want to, as much as possible, even when you're partnering with friends, it's nice to be able to kind of have these relatively loose handshake deals or have a simple JV agreement. I'm putting this much money and this is what I'm going to do. But the scary part comes where you write in all the contingencies. And that's sort of like the back end of the papers that say, here's everything that can go wrong. And if these things go wrong, here's what happens. It's a good thing to use these and also to study these type of things, because one, if you are later pitching to anybody else, having the list of everything that can go wrong shows, one, a degree of foresight and forethought into things that can potentially happen, and it also shows that you have an understanding of what type of contingencies you can put into place should things go wrong, because you don't have to worry about things going right. You have to worry about what happens when things don't. And if they don't, you have to demonstrate that you have a fair understanding of what it is that you're going to do to mitigate the situation and protect the project. Because that's what the contract is for, and your responsibility as an active partner setting the whole deal up is also to make sure that the project is protected. And that's what you're supposed to do. So basically, from what I understand, like, it's, you have a loose agreement. It didn't quite get outlined correctly, and now that there's a lack of fulfillment, you need to decide how to do it. Now the thing about this is that you shouldn't have let, as an active partner, you shouldn't have let her operate in this manner. Your responsibility was to take control of the money and spend it correctly. You found the right project, and now you need to spend it correctly. So it's it's sticky, but even if you have this place, the thing you should think about now is, because they're your friend, you don't need to get so technical and let's say sticky with everything. The point, the name of the game now is finish what you need to, move on. because there's not a lot of point fighting. You said that you already took somebody to civil court. Honestly, the problem that I'm going to see with this is that even if you continue to pursue it, if they simply decide to ignore you, how are you going to go about extracting money from them? Because as much as you might say, okay, I am suing them and I'm going to take them through whatever, is if they're a self-employed contractor and they decide to switch banks and do whatever, they can be quite evasive and it's troublesome. So at the point where you are duking things out through any legal system, it's probably not going to be too worth it, and you may as well focus your energies to resolving the situation and trying to come out on top. Okay, and just figure out how to salvage it. So in this case, I recommend, if you are going to put the money in, just make sure that that is acknowledged and treated appropriately somehow. Either it needs to be treated as a loan or it needs to be treated as an investment portion, right? So there is like a waterfall structure, or if you're raising money from multiple people, you may have a cash call. And that cash call needs to be treated somehow, like acknowledged and recognized in some way in the agreement, in the venture. So if you're putting money in, you need to have a conversation. The thing I want to ask is, are you both still on reasonably good terms? Because that's also going to play into how well you're able to adjust and negotiate moving forward. If you are on good terms, then you should just acknowledge that you're putting in the money, and you should be clear as to maybe go back to what your understanding is of what the contract meant. And as long as it's clear that you are now fulfilling her obligation, then you can figure out a way to value what it is that you're bringing in. So that's what I would do. I would try to just value it somehow that seems fair, and ultimately finish the project. And if she is being a little bit reckless on all these other things, I would really also have her look into, is she going to even be able to burr your money out? Because if you're going to put more money in, especially money that you either need it for something else or maybe it's money that you don't have, will she be able to refinance that money out through a primary or secondary mortgage, right? You're not putting, okay. Okay. So you're not going to be putting any more money in. So if that's the case, then you probably don't need to worry. But then you need to figure out how you're going to bring the project to completion. If you're gonna finish the second unit, you need to figure that out. On one hand, if you haven't put any money in, yeah, okay, got it. Okay, so on one hand, if you haven't put any money in, this is more going to be a detriment to her than it is to you, because she's on title, she's the one who bought the property, and you're the one putting everything together. If she's the one who's messing something up, she's more in the sticky situation. So you need to decide, what is it that you want to do here. Do you want to figure out a way to see it through, or do you want to just walk away from it? Because that's also the risk, right? When I was saying that usually when people come to us with a problem, it's actually the other way around. Is the money partner is complaining that the active partner screwed things up. And technically speaking, if you just walk away, they would have a hell of a problem trying to, correct the situation themselves, especially if they don't know what they're doing. So you're relatively insulated financially. You just need to see whether or not you can turn this into a profitable situation and also salvage the relationship. In my opinion, the relationship is usually the more important part, because I'm sure you're going to have learned a ton of things, and also what their strengths and limitations are. And if you can kind of put all that together, you'll be able to have a more successful venture, whether you do something where you use them more passively or more controlled, or you go work with other people. Okay, so just try to salvage the situation. If it's too volatile or you can't salvage it, then list the property, take your licks, move on. Right? That's usually the best thing that you can do, especially if you got the permits for the basement. Permits for a basement is not valuable. It's obviously, it costs money, it took time, so it is worth something. So, move on and try to go with speed if you can. But if anybody does have questions about JVs and partnerships, by all means, drop them in. I'll be happy to answer them. Part of the reason why I was talking about this today is because we did get a lot of questions recently to do with partnerships, and people were asking questions like, how many people in a partnership is too many? How many people should you be raising money from? uh, how many roles can people have, or should you? Is this like Dragon's Den? Do you have these kind of partnerships where somebody has a background in something and they can bring expertise, right? And as we were talking about it, people, you can look at different elements of partnerships that you should consider, such as it's not always as simple as just like money and active, right? We sometimes break that down in real estate to keep it like that because it's relatively simple. But you see groups of people come together in different fashions of forms. Like you see partnerships of three, sometimes four. You see people buying properties on their own, and sometimes they don't want to because it's very burdensome, right? There were these articles that we went over that basically said that statistically speaking, through JVs and through business in general, solopreneurs default in their business venture um, a certain amount. People who are in partnerships of three have high rates of default or failure, and then people who are in partnerships of two have the highest rate of success, which I thought was interesting. And I think because two is relatively simple, with two people, you can split things right down the middle, right? And there's usually a little bit more cohesiveness. So if you split everything right down the middle, and you have two elements of the business where sometimes there's a front end and a back end. The front end of the business is often going to be, let's just say, more of the active row. And the back end, if you think about it, like if you're holding a rental property, it might be more on the accounting, it might be more on certain logistics, and it becomes a little bit clear how you're going to distribute, let's say, labor or even finances. And further to that, when you have three people, now it starts to get a little bit complicated where you might have somebody in the front, somebody in the back, and then you have somebody who's just freeloading, kind of getting a free ride. And nobody really feels too good about it. And this is where people get a little bit emotional and problems start to happen. So this is why I think sometimes those triple partnerships or four people partnerships, it just ends up being too many voices, and you start to find things being a little problematic. Now, does this still apply to, let's say, if you're raising money, right? How many people should you raise money from? And I know some people, they will raise money from family, friends, and people that they know sometimes, at least when they're starting off, and they will not say no to any amount of money. And here's where you see people start raising money from others in the amounts of like 10,000, 20,000, $5,000, and now people are raising all this little money. And the problem with this is that when you raise money from so many people as an active partner, this is going to mean that now you have this many voices to listen to. And it's not that the person who invested $5,000 is going to be any less significant than the person who invested $100,000. And in fact, I can tell you this from experience, the person who invested $5,000 to $10,000 is going to be much louder than the person who invested $100,000. So you're going to be now dealing with people, because a lot of the times people who invest $5,000 to $10,000, they may have some experience doing stocks or something else, and they're used to something maybe a little more liquid. Very often, people who are doing $5,000 to $10,000, it's like they're not at they might not be at the real estate investor stage yet, right? The reason why people do stocks and everything else is because stocks and everything else is far more easily accessible. Doing private loans like that is not so accessible, and a lot of people don't want to do it if you're only lending out a small amount. You want to do this with somebody more seasoned, and ideally, right? And then you also get to reap the benefit of them understanding that you have to do your thing when the market's doing a thing. The worst is when you have somebody who doesn't understand real estate, who's giving you $5,000 or $10,000, and then when you get a little bit stuck, they become impatient, scared, or they start trying to get into your business of making decisions, and this becomes problematic. So, all this to say, you can still go and raise money, small amounts from people. What I find usually makes relationships fall apart and ventures fail is a lack of clarity. And clarity is the name of the game here. So if you're able, I was talking to the lawyer, our lawyer actually. We had a conversation with him, and he said something that was very poetic. He says, "If you write things down in the agreement, it's like you're writing your destiny. If you leave it open ended, anything can happen. And I thought that was very wise because essentially if you put the things down that you know, you'll be able to control the outcome more or less. You have more control over the outcome than not. Like anything can still happen, right? He's a lawyer, so he's speaking about this from the perspective of the law. But my perspective is also that at the point where you have to lean on the law, it's kind of messed up anyway. But people are very responsive to putting pen to paper. So if we agree to something and I say here, it's in the agreement, whoever I'm dealing with is more likely to be agreeable to that rather than not. So I definitely find there's a lot of value in at least writing things down. We do it with our tenants. There's no reason for us not to do it with other real estate investors and partners. Okay, so write things down as much as possible. Have the outcomes. I know Adri writing. I'm looking to get into JV with my long-term friend. I would be coming into I would be coming in as a money partner, and he will be the active. One of some things we should do to prepare. So like I said earlier, the biggest I would outline it so that work is paid. Okay, I don't like working on promise. Sometimes people will do these partnerships with, let's say, a contractor, and I think these are the most tricky partnerships ever. Adri, if you can tell me, like, what is your friend looking to do as an active partner, that would be helpful for me to answer this question. But just going on the promise of what an active partner will do, if they fail to fulfill their obligations as an active partner, if you haven't budgeted it, you will be out of luck. So this is why I say that when you're structuring a JV, the active partner should have a clear measure of what it is that they are supposed to do. And usually where I see active partners fail to fulfill their responsibility is in the fact that they will run out of their own money, right? So if I come to you with as an active partner and let's say, hey, Adri, I want us to get into this JV together. I find a deal. I'm going to manage the project. I'm going to make sure that everything is going Gucci, and I'm not going to take any money for this because this is this is my fulfillment part of the bargain, right? Kind of a real estate arbitrage. Okay. If this active partner has their own financial obligations and they're doing a bunch of legwork more or less for free, there will come a point of financial stress in their lives, and they start having to kind of look in different places for what it is that for some way to make money. And I find that the best way to keep the active partner motivated is that when they do something, they get paid. So if it's a flip and they're a contractor and the construction work is worth $100,000 and they're going to do the work, they can give me a discount at it. But the thing is that they should take less of the proportional share of the profits at the end, and then they get the $100,000 for the work that they're going to do on the project. This way, if they disappear because, life happens, I have money in the pot to pay somebody else to do it. It's like you shouldn't partner completely on promises because it doesn't allow you the ability to fire, pivot, and adjust. And that's what you have to be able to do. So if you're doing this with a friend, honestly, try to make things as clear as possible. The money should be in the beginning. As few things as possible should be built on promises. And then after you have as many of those things set up, try to set up contingencies. Think about problems. And this is where I want you to get into a room with people or talk to people who have experience with partnerships or ventures, and especially people who have experience with things going wrong. Because if you have an understanding of what can go wrong, you'll be able to protect yourself against these things. Some examples that I think are like the basics of what goes wrong in a partnership is our evaluations didn't work out. We run out of money is another one. Or, just something happens to the project where it didn't go right. Like if people end up in a situation where the tenant stopped paying rent, right? And they're just stuck with a guy in there who's not paying rent, and now you don't know what to do. You can't sell the property, you can't collect rent. What is it that you do? And this is where you want to think about the contingencies, where at least if everybody has an understanding that these things can happen, and if these things happen, we're going to pull together, and it's not going to be one person's doing all the heavy lifting while the other person is sitting back letting the other person do it, that we are both going to participate and share in the damage collectively, right? That's what you need to make clear. And this will protect your venture, and it will protect your relationship, because you said that you're doing this with a friend. So you don't want to lose a friend in doing this. Okay. Um, I know Cindy asked if I had example JV agreements. Yes, we do. I don't have them here with me, but you can message me later and I can try to help out with that. But yeah, no, JVs, they can be tricky to do. And I do feel that compensating people, and I know this, by the way, just as a personal story, I've done this with my brother. Like, I partnered with my brother, and he came in and he did the work. And the worst part is my brother does amazing work. But, working with family, um, okay, got it. Okay. Working with family becomes tricky. And obviously, if my brother was helping on a flip, if he wasn't like hustling, how do I and I trust him, right? I knew he was going to finish the job. It's just he wasn't. At some point he was just getting a little bit slow with it, and I can't. It's not like I'm going to fire him, right? But then also we ended up incurring more costs, and he didn't charge us for any of the work because he's just like, that's going to be my investment portion. So what do I do in this case? You get stuck, right? And then this is where I take my licks and I'm just like, yeah, I'm not doing that again, And even now I had a conversation with him and I'm like, anytime from now on, even though we're family, it doesn't mean that because we're family that we're always going to be reliable to each other. Life happens. People have problems, people have things come up, and it doesn't mean that they're always going to be operating at peak. So as real estate investors, the biggest leverage we have is our financial resource, our ability to leverage. If we know how to control the money, we can use the money to influence results. So never leave yourself without a financial option. Do not work on promises. Okay? So that's Adria is basically what you should make sure to do when you're with whatever type of arbitrage you're trying to set up. Nothing's on promises. Everything is about fulfillment, and people are motivated by money. So it's good when somebody knows that if I go do this, I get paid. So put money in the pot so you can pay people. All right. Okay. Yeah. Any other questions? By all means, drop it. Otherwise, I'm going to tell you guys a couple of other things here that I felt are relatively important in terms of understanding JVs. So for JVs, mostly, I think another thing that is important to illustrate here is that everybody understands the idea that when somebody's going to be investing into something, they're very rarely investing in the project themselves. And then when somebody is an active partner and they want to go out and find a deal, very often they struggle with the idea, do I find the project first or do I find the money first? And I feel like this is a question that a lot of people struggle with because they'll go out, they'll find a project, and then wholesalers do this, right? They go out, they find a project, and then they say, hey, which house flipper wants to buy this? And then they write up a presentation and they pitch it to people. Now, wholesalers who know what a good project looks like are often quite successful with this because they know their client base, they know who they're selling to already, they know what is a good deal. But people who are not as familiar, they end up finding a project and then they try to get the money and then they're unable to get the money because they didn't secure a good project, and then nobody is buying that project. They have to let it go. Sometimes they lose their deposit, things happen, but it ends up being a bit of a waste of time. So how do you avoid this? The way that it's always that you find the people first, or they say that if you're going to find a deal, anybody's going to pick up a deal and anybody will want to invest in a good deal. But if you do not learn what the people want first, you're not going to be able to find a good deal. So yes, you can go out and find a deal and then find the people as long as you understand the people. But if you're just starting out or if you don't quite understand who you're raising money from, you should go find the people first. And you're going to learn a couple of things. You're going to learn what motivates them to invest. And you're probably going to find that they're not as motivated to invest in the project as much as they are motivated to invest in you. So whoever you are as a person, whatever your character is like, this is what they're fundamentally going to be investing in. And when people talk about like what is some of the most important things that you are looking for in somebody else in order to invest, the first and foremost thing that they are looking for is trust. And they look for this above all kinds of things. They look for this above ROI on the project. Or they look at this above time frames. They look above this, like the contract, everything else. Most of the time, they have a conversation with you, and if they like what it is that you're saying or what it is that you're doing, and they trust you, that is fundamentally what is going to make them invest with you. Okay, and then the agreement is all the details later. But trust can come in a variety of ways. It can come from, let's say, credibility can come from how you present yourself. If you showcase previous projects, obviously that goes a long way. If you are having a robust agreement, your presentation of it is going to affect people considerably. And this is where, just because you want to show that you've thought of all the problems that can happen in a venture together, you don't want to scare people off either. So this is why usually what we do is we'll have like a nice 2-pager, and we'll put this 2-pager in the front of the agreement and saying this is the simplicity of it. And then we have all the legal jargon at the back. And it's like, after we said all the pretty things, here is now all the ways that the lawyers would write out, if all these things go wrong, this is what happens, right? It shows that you're prepared, but you always want to balance that out without being too intimidating. And this is why fundamentally, if you can build your relationships and you can build credibility and you can build trust, they will invest with you no matter what project you're doing. And this is why it's important to develop a track record and show what it is you can do over a period of time, because that is what makes people develop faith. So try to work on that if you are an active partner. Okay. If you're somebody who wants to be passive because you have a career, this is what you want. This is what you want to be looking for in people. Somebody who seems like they're going to be real. People who promise exorbitant returns, they're often like pretty risky. Long-term investments are going to be considerably more secure and give you more versatility of risk, more versatility in risky situations. A lot of the times people come in and say, I want to only do a 1-year project and I want my money in and out quickly. And I feel like there's a certain market where that works, but you always want to have the versatility to pivot into something else. Like we do house flipping, and our house flipping is our main bread and butter. And sometimes people say, it doesn't work in certain markets. Anything works in any market. It's just a matter of adjusting your numbers accordingly. It doesn't work when you're on a downhill market, but that also means that nothing works in a downhill market. Burring doesn't work. Flipping doesn't work. You name it, it doesn't work in a downhill market. That's why our market stagnated for so long, is because while things are on a downwards trajectory, nothing will work, right? You can't, it's going to be very challenging to make money. You have to be able to find such a good deal in a downhill market where you're like extremely predatory in order to make something work. Because all the real estate strategies fundamentally work on the same principle. You need to capitalize on opportunity, and that opportunity is often some kind of desperation. And right now, where a lot of people had to list properties on the market and were about to lose their homes because their mortgage came up for renewal, they weren't able to extend the amortization period, and they were forced to put their property in the market, they may have had a lot of equity grow into that property, but people who are homeowners are not necessarily going to be thinking like real estate investors. They just ended up taking a big hit on their equity. So if somebody had a property for 15 years and now they had like a $500,000 mortgage, but they're retired or they're on a fixed income and they didn't plan it, and now they need to sell their property. Somebody came in and offered them on an $800,000 property $600,000. They don't even care that they lost $200,000 because that money wasn't even real to them. For a lot of people, a home is a home. It's not an investment, and equity is just monopoly fake money in a lot of people's minds. And this is where, wholesalers, other real estate investors will go and try to capitalize on certain people's situations. And there has been a lot of that happening because people who are not real estate investors are often penny smart and dollar poor, where they're not looking to protect the equity. They weren't working a job. They weren't able to refinance, or they didn't know how to, and they just thought it was easier to just list the property for sale and move along. And this is where people are capitalizing. So if you want to JV into a project like that, actually the reason why I was mentioning the house flipping thing is that when you're employing a strategy, even when we are flipping a house, if you want to make sure that you have securities in your contract, a house flip, you can say that it'll work, it'll make us this money, and then should this fail, we pivot into plan B, which is burying the property and renting it out. And then if plan B fails, we're going to go into plan C, which can be whatever it is that you want to do. You can say that you're going to redevelop it. Like, we have a very simple process where if we decide that we're going to flip a property, it doesn't work out because the market hits or something goes wrong, we rent out the property, we bury it. And if that is not going to be good enough, then we do plan C, which for us is a long permit. So some permits take quite a while to do. going through architect, getting your drawings done, going to the city, applying for permits, rezoning if you have to do it like that. You have to do the surveys, the studies, anything like that. It becomes very time consuming. So why would we do that? We would only do that if we are forced to hold on to the property and just keep it for a period of time. And if you're doing that, you might as well do a long permit. Part of the reason why a lot of people don't want to do permits to begin with is because it takes a lot of time and it costs money. And while you're doing it, more often than not, people are sitting with vacant properties. But at the point where your property is occupied, at the point where you have to wait out these, hard times in the market, you might as well do some permits that are going to significantly increase the value of your property. So if you ever find yourself stuck and you're able to make an agreement, it's good to put things into the agreement that show that you have plan B, plan C, some kind of contingency. Okay. And what happens if somebody wants to exit the equation? Can they, or are they stuck? And this is going to affect your pitch, because if somebody reads a contract and says, if we get stuck, we're all stuck together, somebody might not like that. Another thing to consider is that when you're raising capital, you're playing with other people, you have to make sure that it's a good idea anyway to make sure that people are using investment money, not their kids' university tuition. Okay. Sometimes people invest money, they say, I want to invest it for a year, and then they need that money in a year. And if you are unable to sell or unable to find somebody to replace the position, you're going to find yourself in a troublesome spot. Avoid those things. Okay. So if you're doing ventures with friends, if you're doing ventures with anybody, it's good to speak to somebody who can kind of coach you through, all the things that can go wrong, not to scare you, but just so that you have some foresight into like some of the circumstances that you might face. All right. If anybody has any questions, there's a few more things I can share, but I'm hoping I'm getting some of the brain juices going with some of this stuff, because these are things that people encounter all the time. Real estate investing and partnering with people sounds really great and all, but people mess it up because a lot of people have the wrong idea of what a real estate investing means. People partner because you're less scared when you partner. If things go wrong, you have somebody to share the burden with. But those burdens aren't perceived in the same way, person to person. So having an outline of such burdens is going to be very helpful in preserving relationships and setting expectation. So setting expectation is important. Okay, what else can I tell you here? Let me see here. I had some notes. I'm going to just pull that up. Okay. Oh, yeah. Okay. So partnering with people. The last thing that I wanted to talk to you about when it comes to partnering with people is, how do you go about how do you go about managing taxes and other things, and should you go through corporations? And I feel like there's a lot of things that you need to consider here. So when you're I'm going to call it, when you're Mickey Mousing it, right? When it's not Mickey Mousing it, but when you're first starting out, people can do all kinds of things. Like there's tons of tax shifting that you can do, and there's tons of ways that you can declare things to avoid certain taxes or capital gains or anything like that. Now, just to be clear, this isn't going to be tax advice. This is just the way some people do certain things and the way we do certain things. And I want you to also understand that when it comes to your taxes, if people talk about it as if though some things are loopholes or anything like that, and it's not that there's loopholes. There's no such thing as gaming the tax system. It's not gaming the tax system. If you're able to save on your taxes, it is because you have an understanding of the tax system and the way that it works. You're not trying to do anything illegal here, and you're not supposed to misrepresent anything. It is very simply what you are able to substantiate and what you are not able to substantiate. For example, like tax shifting, the whole thing about it is that if you're going to do it unethically and you're doing it and it is not true, then that is going to be pushing into the realm of like what you shouldn't be doing. You're going to be breaking the rules. But let's say I see people and the way that they deal with taxes. If let's say you're doing a property and you're going to be buying it and selling it in less than a year, or if you want to avoid capital gains taxes, right? There's a few ways that you can go about dealing with that. But one is, let's say, husband wife couple, they'll buy something like that. If the wife is not working, the property should definitely go under the wife's name, and that way they fall into the lesser tax bracket for the profit margins. Other people looked at whether or not you can put the property under corporation, and that's fine if you plan on doing regular flips, because you're able to move that income, the capital gain, into active income, and you're able to write off a ton of things, right? It's going to be different than if you're doing under your personal name. Um, but how do you go about separating it in terms of, like, if you just have like two or three people on title? And that's going to be done in the beginning. You should have some foresight in that as to who's going to declare what income, so that you can line it up accordingly. And that money has to go to that person. So this is where the trust in the relationship has to go, because, it's the same way where people will use family members as straw men. And let's say if you're flipping a property and they're going to hold it for a year, and you want to avoid the capital gain tax or something like that, you put it under somebody who doesn't own another property, right? And this is why sometimes, like, and again, the husband wife thing, wife will take 99% ownership of a property, and then the husband, if he needs to co-sign on it, he'll co-sign on it or sign it as 1%. And then the wife essentially doesn't pay capital gains on it because they own the property. And if it's just being renovated, they can shift their address there for a year. And that's how they're going to deal with that. When you start to scale up and you're doing something that's a little more active, or you're burring a property, people will do different types of things, like have their kid rent there or something. But if you say you have a triplex, you only get to push out 33% effectively of those capital gains for the time that they were living there. So there's going to be tons of ways that people will work these things. But if you're doing partnerships and they're declaring income, and you're putting it through a corporation, the person who's going to pay tax on it is often the last person who receives the money, right? Because the company that owns it could be holding it just on name. And our experience is that the CRA doesn't care who pays the taxes as long as somebody pays the taxes. Okay, so you need to be able to move these things accordingly. But keep in mind, when you start to put property under a corporation, it becomes more challenging to get residential mortgages. I know some people do it, but it becomes a little bit troublesome. And if you're looking to partner with people, it's not just a matter of, you don't have to be partnering only in money. You don't have to be partnering only in active role in terms of like finding the deal. You can also leverage people in terms of qualifying criteria, taxable income criteria, where they can hold real estate and pay minimal taxes on it if they take the profits. And everybody has something different that they can bring to the table. So you just need to really be clear on what it is that you need. Try to outline the distribution in the agreement as clearly as possible, set the expectation. And then from there, you'll be able to have like a relatively smooth fulfillment of the partnership from a contract perspective. Your real estate, I hope it operates just as smoothly as this thing can. But that's pretty much the majority of things I feel like you need to consider. So before we start wrapping it up, it's 7:50. Does anybody have any other questions that they want to throw in about partnering and joint ventures? By all means, throw it in. Otherwise, I'm going to hit you guys up with one more thing and then I'll wrap it up. All right. All right. I'm not sure what you mean by services as working partners. Glad you're learning, Taco. Glad you're learning. And yes, Audrey, no problem. Use your services as part of working partner equity. Use your services. Okay, so if you're asking if somebody can use someone's services as part of the working partner equity, right? Like instead of charging. Yeah, so that's what I was saying before, that let's say I did, and that's where I'm a little bit adverse to that. Just because it's still a promise, right? So if I say, if we partner and you say that we're going to use your company to do X, Y, and Z, it's okay for your company to give me a discount on whatever work is going to be done. But I do still think that the money should be in the pot, because if something happens to you in this relationship, it's really ideal if we're able to pivot away should we need to. You always want to have money in the pot. Okay, so to rely on the services, the advantage that you and your services bring to the equation is really reliability. You should still get paid for your work. Okay, and that way, because what happens if something goes wrong or there's more problems that happen and your workload increases? It's okay for you to float the increase of work, but it's not okay for you to float the whole thing, right? Again, I've seen too many people promise to do work and then life happens, they have an emergency, and they can't fulfill their end of the bargain. You need money in the pot to hire somebody else. All right. What options are there if you refinance the house to pull out and you don't have enough? Okay. To pay the partner. So that's a tricky one. So that one, see, what you're asking is what happens if you do that and you don't already have it outlined in the agreement. Okay, so pretty much in this case, in your case rather, if it's not outlined, you have to you do need to have a conversation and work something out there. If you refinance, the way to do it, you need to what you need to do in order to make it relatively clean and avoid yourselves going to court and seeming like you didn't do things fairly, you should get an appraisal of the property. When you get an appraisal of the property, you're going to look at whatever mortgage you have on it, look at whatever you spent on it, and then you're going to divide that and see what those profits are. Whatever those profits are, if there's any, that is the money that each party should get, their buyout. So in order for you to buy out a partner, you need to find out you need to appraise the property to find out what are your profits or your losses. You're going to find that. You're going to plug that into whatever money went in on both sides. Okay, and you said that you didn't actually put any money, or you're in a position where you may have needed to put money. What you're going to do here is you're going to take the profit or loss, and you're going to write out a profit or loss based on the appraised value of the property, and then you're going to see what you can refinance it for. Whatever you can refinance it for is going to be different from the appraised value. It's not necessarily going to be the same, but you're going to take the appraised value, and then you're going to use that to distribute what each person should get back from this. So let's say you lost $50,000 on the project. That's $25,000 each. The lady who put in money should get whatever capital she actually put in, less $25,000 loss. That is what she needs to get out. So if you refinance the property, that amount of money is what they should get. Okay, so that's what you need to do in order to buy somebody out. If they are buying you out, you still need to do an appraisal of the property and see what your profit or loss would be. If there's a loss, not getting any money, right? So that's what it comes down to. But in your case also, because they're with an A lender, honestly, if they went with fixed, it's going to be extremely expensive to break that mortgage. So you have to see what the term is. I don't think you're going to be able to break it without paying exorbitant fees. The best case scenario, if you want to BRRRR it, is probably going to be getting some kind of a second mortgage on the property if you're able to. So you really need to look at the mortgage terms, okay? And this is where, like, again, when you have somebody who's qualifying for the mortgage, you really need to clarify to them what mortgage they need to be getting based on the plan. And this is why a lot of people go for private mortgages, is because you can do like a 1-year term and then you can get out, and it's cheaper, because otherwise you're going to end up paying like if I wanted to break, I have one fixed mortgage on a property, and if I want to break it, and the mortgage is for like $600,000. If I want to break it, it's going to cost me like 40 something odd $1,000. It's crazy, right? So I don't want to have to do that, and I don't think anybody here does. So always have a plan. Always make sure that the financing is in place correctly. And if you're bringing somebody in for qualifying criteria, you need to know how to vet like a mortgage broker. You need to know how to vet like a bank. You need to know that they can qualify. In order to know that, you need to know what are their assets, what are their liabilities, do they actually qualify, right? So it's weird to ask a money partner for that, but how do you know they're going to be able to pull? So you have to write these things in. At some point, you can work on trust, but the more you leave to trust, the more you're susceptible you are to problems. So anyway, guys, I'm going to leave it at that. Anybody have any questions? You know where to find me. You know how to hit me up. Instagram's the easiest way. But otherwise, best of luck. If any of you wants any help with that contract, shoot me a message and I'll see if I can pull one up for you guys, okay? Take it easy. Have yourselves a good night.